In an attempt to diversify, many investors will look to invest in smaller and up-and-coming companies rather than the big giants we're widely familiar with today. There are some important differences between big and small companies that present both opportunities and risks when investing in their stocks. Let's first define what a small company is. It's essential to know what a small company is when it comes to investing, as this definition is not as clear-cut as it seems. The size of publicly traded companies is often classified according to market capitalization. That's the sum of all their shares multiplied by the share price. Checking these things is an important step to take. Many people buy into small company funds, thinking they're getting exposure to early-stage startups. The odds are that won't be the case, so make sure you're getting what you think you're paying for. But why do people invest in smaller companies? Investors tend to expect a premium return when investing in smaller companies. There's the hope that there's more opportunity for share price growth, and thus a higher return on your investment for taking on more risk. These risks help explain why smaller companies perform differently from large ones. Investors have to decide whether this risk will be worth the reward or manage them through the stock selection. But that's not always going to be the case, and it's important to know about the risks so you can manage them better. Here are some key points to note when investing in smaller companies. Number one, the law of diminishing returns dictates that the growth rate for a business must slow as it gets bigger, thus making the potential growth of small businesses more appealing. Number two, smaller businesses fall at a much greater rate than big businesses, making the risk of investing much higher. Number three, there are always exceptions. Today's mega-cap companies continue to grow rapidly, and many small businesses are swallowed up by large ones before they mature. What are the types of ways that you can invest in smaller companies? A typically popular option for investing in small companies is to find individual shares to buy. The biggest problem here is narrowing down your search. There are hundreds of small companies listed in the UK alone, so just saying you want to buy shares in a small company leaves you with a lot of options. ETFs are another option for investors. Different ETFs have different definitions of what cap size classifies a firm as a small company, so do your research into each ETF to see what firms are in that ETF. While smaller companies can be riskier than larger companies, an actively managed portfolio doesn't have to be. Investors can manage risk by balancing exposures to these different risks. Subscribe to XTB to learn more about trading and investing.